Good evening, everyone, and welcome to this excellent to be episode of the markets and the way forward. So, still a lot of participants are joining the webinar. So, we'll be starting in next 1 minute. So, again, I want to welcome you all to this webinar, and please note that we'll be starting in next 1 minute. Okay, good evening, everyone. So, we are ready to start, and I hand over the things to our head of research, Mr. Mayuresh Joshi.
Hi guys, good evening. Thanks for that, Rushit. I hope you are able to see me, and rather more than me, I think you are able to see the presentation and hear me very loudly. A few chats saying hi, hello, we see fine, should be okay, and we can move ahead. And sorry for the delay, I had some issues on my Outlook configuration, which was happening. So a few chats saying hi, hello, should be okay. Rushit, can you see the presentation? All others as well?
Yes, it's perfect.
Perfect. I think a few chats should also be good. A few more responses should be good enough, guys. Perfect. Perfect. Super. Yeah, good enough. I've got a good enough responses. We are good to go. Evening, everyone. This is Mayuresh Joshi of Markets with India. I've got with me Rushit. And obviously, we will be talking through in the next half an hour, 35 minutes on where the markets are positioned and the way forward. Honestly, I think the data speaking, we had one of the worst falls in market for the financial year. Obviously, the markets have been very, very volatile since the beginning of this financial year for a variety of reasons. First, you had the issues related to what happens in Israel and Iran and the tensions that ensued thereof. It's somehow simmered through, and the market started its fine uptrend. Even if I see right now, the European markets are doing just fine, and the expectations in terms of a slow and steady economic recovery in the European region is something that is propelling the European markets generally. The US market data surprisingly looks strong at this juncture, but with the volatility that is also exhibited in a lot of their data points, a large part of the market now believes, with the stickiness that is being exhibited by the core inflation, is a large part of the market believing that inflationary pressures might still continue, and therefore the rate cut cycle might just remain a little bit postponed. So, where the markets were at the beginning of the year with 4 rates, we are now positioning ourselves for 1 or 2 rate cuts as we speak. A simultaneous move can probably be expected across a lot of global markets across the globe. I think today's fall specifically was accentuated by the fact that the voter turnout, the primary reason being voter turnout remains extremely low for whatever reason, whether you are talking about the heat continuing in the country or expectations in terms of a large part of the base not coming out and voting because of a combination of all these factors, including heat wave, traveling to in distant cities, towns, and villages, traveling to a certain location to cast their vote, so on and so forth. But the fact also equally remains is that markets have moved up significantly. You are seeing consistent FII selling, and also the fact that some of the results have not been up to the mark. As an example, out of the heavyweights, L&T's guidance disappointed to a large extent. Asian Paints had very soft numbers. You're probably looking at HDFC Bank also not performing to the extent. And the Reliance to a certain extent, because of the seasonality that we had seen, the numbers were a little bit on the softer side as far as their overall consolidated numbers are concerned, though few of the divisions did perform well for Reliance. But all these stocks have a huge weight in the Nifty itself. And therefore, any kind of earnings mismatch, any kinds of deterioration in terms of price clearly reflects in terms of how the Nifty probably slips. Also, in the mid cap and the small caps, the outperformance has been relatively superior compared to the Nifty over the past 2 years. Some of the PSU stocks, as an example, whether they are in the power space, defense space, railways, construction, have moved up 5, 6, 10 times in certain extent over the last 3 to 4 years. Also, generally, I think a lot of stocks in the small and mid cap space have moved up significantly. So I think if there is some element in terms of a shakeout in the market, the corrections also are equally brutal. But those corrections probably remain sustainable. Is the correction structural? Is something that we need to see. And therefore, the way we look at it in MarketSmith India is through our count in terms of the distribution day. So the slide that now you're seeing on the screen, we have changed the status today to uptrend under pressure. So if you're generally following smart folios, and if you're generally following MarketSmith and CanSlim, what we try to suggest through CanSlim is that earnings become a very important focal point for stocks, for sectors, and for the market whole. But generally, if you're probably looking at a lot of aspects in terms of how these earnings impact the market to a large and to a very great extent is the consistency and compounding of this earnings. And therefore, I think distribution day, as you probably are seeing, right, where it is being marked, the count is 3 as we speak, is where the market corrects 0.2% or more in a periodicity of 25 days if I compare the index or the sub indices as a benchmark. So generally in MarketSmith, we take Nifty as a benchmark. So to that extent, if the Nifty corrects 0.2% or more on a particular day in that 25-day trading cycle that we are speaking, on volumes which are higher than the previous day, we are in a certain way counting or mapping that the market is trying to tell us something through these data points. And these data points have worked wonderfully well over the last 60 to 70 years, as O'Neill himself had envisaged and devised this technique across global markets in different time periodicities and time cycles as well. So in this particular time cycle, all the corrections that probably came through were very, very shallow. So to a certain extent, even in the past few weeks, even in Israel and Iran, the correction came as the clarification came, the markets bound back and we came to an all-time high. Again, today that we are probably seeing, we are at a count of 3. We have broken the 50 DMA. And therefore, these 2-3 parameters from a distribution day count help us in a particular time cycle identify whether the market is making an intermittent top. And if that is happening, you should be a little bit careful in terms of having your aggressive positions in the market as well. As simply put, the 4 different phases of the market which are put in M of CanSlim in terms of market direction determine confirmed uptrend, which we were till today. As we have downgraded the market to an uptrend under pressure, it clearly means 2 things. One, the 50-day moving average has been breached, which is a very, very important sign as we monitor this very, very closely at O'Neill. And the second element also is that how sectors are probably performing vis-a-vis the overall index move. Now, a general ideation is that if the index has cracked, a few of the leading sectors which have a high weightage in the index, I gave you some examples. Banks have a large weightage in the index, including the likes of HDFC Bank, ICICI Bank, State Bank. State Bank surprisingly gave a decent set of numbers as well. The second element that we are probably looking at also is, Rushit, let's keep that slide because I just want to mention the Lakshman Rekha part. is uh, stalling, right? And I mentioned this word very, very clearly in my opening remarks. Stalling is nothing but uh, where a particular stock, as an example, opens, it goes significantly higher, but at the end of the day, it closes where it starts off and with extremely heavy volumes. If this is an indication happening for a large part of the leading stocks in the market, you can very well assume that institutions are slowly and steadily probably supplying that stock into the market. And because there is a frenzy in terms of missed out feeling for the market of people who have not been able to participate in the last few weeks or months, that inherent missed out feeling gets reflected in terms of buying at every opportunity that you see. But our take is that 50 DMA has acted as a Lakshman Rekha. So if you see, those arrows have been pointed out right from 21,100 a few months back, where it again tried to come back to those levels but could not breach that. And on multiple occasions, that 50 DMA was not breached. And that was what I was indicating, that even if the correction was coming, 50 DMA was a very, very strong support for the market. And those corrections were short lived and an immediate bounce back happened. But today, as the correction has happened, do we get very, very aggressive, assuming that what has happened in the past, we should continue? We at O'Neill have always believed that you should look at data points. And once the markets have been shifted to an uptrend under pressure, we should now monitor over the next few days or next few weeks what the next move of the market will be. Is there further selling pressure in the market which can take the market as far as the index is concerned? The next level to monitor now is clearly the 200-day moving average, which is significantly lower from where we speak. But if there is some element of issues that come through, both at the domestic level, as I mentioned, these pointers that were probably happening in terms of the low voter turnout, which is the fear factor for the market at this juncture. Some of the earnings, specifically from good names, large names, specialty chemicals as a basket has clearly disappointed. A few of the small payment banks have disappointed. A few of the uh, PSU names also have disappointed in terms of earnings expectations. And therefore, I think if a large part of the market, based on both these factors, are coming down, and if we actually come down and close to that 200-day moving average, I don't know whether we will or not. But since we have shifted the market under pressure, we will be very, very cautious in terms of aggressively adding new positions into the market right now. We will wait for the markets to give us the signals on when to enter. And when will that happen? It will happen if the market does not breach its 200-day moving average, which is significantly lower. If that happens, there is an inherent pressure onto the markets, which will get reflected not only by the index, by all different sectors and all leading stocks within those sectors. Or we alternatively wait for the markets to reverse as it has done in the past. So if it reverses, what we are probably seeing is that over the next few days, it will gestate that we were trying to be fearful. It is not the fact. Let us wait on how the next phases of election, if this is the primary reason why the market is probably getting boggled down, is getting an uptrend in terms of a recovery process, and therefore wait for election results so on and so forth, which is anyway around the corner in less than 3 or 4 weeks' time on the 4th of June. And before that, we'll have our exit polls as well. So if that is the fear factor for the markets will automatically react. And if the near-term high that the markets have taken is taken off, we will push the markets into a confirmed uptrend. And alternate is also all the key moving averages, which is the 50, the 21 and the 100 being taken off, and the market is sustaining above that with extremely heavy volumes will also become a good sign to probably look at that the market is now looking at events which will happen in a favorable manner. And therefore, we come to the next slide in terms of how the returns heat map for the market have largely been. And the returns heat map probably indicate to a large extent the entire perspective that I was putting forth. So if you look at a 1 week, 1 month kind of a return across sectors, it has been very, very volatile because the markets is yet to make up its mind after the huge run-up that we've probably seen on which sectors might assume the next leadership position. Now, since I was talking about the first and the second slide combined together, at O'Neill, the belief has always been that as we enter into a different time cycle, and say over the next few days, next few weeks, we enter into a correction phase, we probably try to find a bottom in the markets as the election results are out around that after those dates as well. And the market tries to come back into an uptrend. Maybe new sectors will come into focus, which were not the market leading sectors in the previous time cycle rally as well. And therefore, keeping an eye open in terms of which sectors can lead the rally can come through the filtered lists at market we closely track in terms of our industry classifications, in terms of our sectoral rotations, which I will take you to the next slide. But on this slide, largely, I think the kind of returns that have been over the last 1 month have been very, very minuscule because the markets ideally want to see what might happen now next 4 weeks in terms of elections. And though historically, if you probably see, just reading some data point, even in 2019, between phase 1 and 3, there was a similar reaction onto the index. The Nifty corrected between 4.5%, because there was a similar low voter turnout. But in the end, I think the existing NDA government won with far larger seats than 2014. Again, it's an event-based risk that the market probably enters into. What will transpire in the next few weeks in phase 4, 5 of the elections and actually comes through on June 4th as the polling day comes through is a different ballgame. But assuming all these data points put together, and we look at data points as a fact-based investing mechanism with a keen eye in terms of how indices, how sub-indices, how sectoral compositions are placed overall in terms of the market construct, the technicals helping us in terms of supply and the sentimental factors driving the market. All these combinations of factors put together will help us drive the kind of entry points that we are seeking into the market over the next few days or weeks. But again, at this juncture, we'll remain a little bit cautious because we have downgraded the market to an uptrend under pressure. We will like to see what the market does in the next few days and weeks as we head, as I said, in the closure of the elections and the results thereof. And the markets themselves will give us signals and signs to start accumulating our positions as that time cycle approaches, and which sectors will probably assume leadership positions. Having said that, what is now going to be important, combining the first and second slide, is which sectors might start delivering better in terms of earnings growth. And again, I think the earnings growth is something which is a premise, not just for the markets, because we've always heard that markets are a slave of earnings. How earnings determine the forward ratios for the market. Are markets overvalued at this juncture? And therefore, at O'Neill, what we do in terms of our EPS ratings and rankings for each individual company, what we do in terms of ratings and rankings as far as earnings are concerned, and the relative strength ratings and rankings as well, help us determine the kind of earnings expectations that the markets put forth in certain sectors based on historical trends. How have those stocks or sectors performed in the preceding 2 or 3 quarters? How have those stocks performed in the preceding 2 or 3 years, which gives us a consistency in terms of that larger time period on how that EPS rating has evolved for that company, for the leadership stock within a sector, how sector positioning is happening, and ultimately how the index positioning is happening vis-a-vis all these different sectors and their leaders expected to perform. Just to put a case in point, if a large part of the bank is not expected to move in terms of earnings, the bank index will underperform. If a large part of FMCG companies, including leadership stocks like an HUL, Nestle, Britannia, do not live up to returns expectations or earnings expectations, a large part of those FMCG universe will underperform. And similarly, is the story for IT, which has largely disappointed, especially large cap IT in terms of return expectations and earnings expectations as well. So if they don't perform, their earnings gets impacted ultimately because they form a large part of weightage in the Nifty earnings gets impacted. And therefore, the consensus earnings call for the index of 12 to 15% earnings growth in the next year and around 10 to 11% the year after that gives us that the compounded earnings growth should be around 12 to 13% over the next 2 years. Now, which of these individual sectors in terms of EPS rating rankings and the leadership stocks within those sectors will have a larger earnings growth is what we need to determine through the mechanism that we follow at O'Neill. But coming to sector rotation purely, I think the graph is very, very clear. The top right quartile indicates the outperforming and the improving sectors, which still remain capital equipment. You've probably got transport, retail, healthcare, which are looking extremely strong, and consumer staples and basic materials as well. So where the domestic cyclical part of the story is, that part of the story still remains extremely, extremely strong because the market is of the belief that capital expenditure from the government side, which is the government capex, will continue at a very good pace. The expectations in terms of the NDA government coming back, continuing with its policies, reforms, and processes related to a lot more sectors. You've got the Gati Yojana. You've got a huge allocation happening in terms of road, more than $32 billion, towards railways in excess of $33 billion, more than 60 airports expected to open up, 60,000 crores allocated to Nal Se Jal. You've got a huge pipeline in terms of expectations of green energy, pipe gas from 6 to 15%, 500 gigawatts of renewable energy by 2032. You've got a lot more done in terms of the PLI schemes that have got introduced for electronic manufacturing, PLI schemes for textiles, as an example. Clearly giving to the indication that we are, as the European countries are looking at China plus one, we are getting equipped of being self-sufficient in terms of providing our companies with those resources to fulfill those requirements as well. Expectations in terms of more orders coming for railway companies, as an example, power companies, as an example, defense companies, as an example. So the structural element of what the market is looking at, defensive stocks, which get reflected in capital equipment companies, to transportation in terms of basic materials, get satisfied from that. And even in terms of healthcare, a large part of that market was underinvested 4 quarters back. US generics has become a clear problem. They are falling shortage of drugs. Forget the specialty drugs or the specialty ANDs that pharma companies produce. Even on the generic side of the business, I was reading through a few global reports which are suggesting shortfall in the US market, which probably makes us believe, with India having the largest manufacturing facilities as far as the US markets are concerned in terms of formulation or the API business as well, and China not clearly able to supply. I think healthcare generally, including pharma, probably some elements of diagnostics, and probably some elements of hospital stocks as well, which have done exceedingly well in the last few weeks, can continue doing well in terms of the earnings trajectory. A few of the financials, as I said, a few of the small payment banks, as an example, a few of the smaller private banks disappointed. A few were outliers. ICICI Bank, Axis Bank gave decent numbers. Today, SBI's numbers were also good. I have to still read the transcript or listen to the con call. But prima facie, looking at numbers, they looked very, very good. And therefore, what is getting placed in terms of the bank index itself? You're probably seeing, as you see on the left-hand side, so I've made two columns. If you probably look at the left-hand side, SBI, Axis are trading above key moving averages. Again, good numbers supporting them. Bob also had a huge positive news in terms of the reversal in terms of the RBI ban that had been put on that. Kotak had a huge RBI directive against that, and HDFC Bank has been one of the clear underperformers. So somewhere that offset effect is keeping on happening. The index has breached today its 21-day moving average. So if you're looking at the lines right on the chart, folks, the green line is the 21-day, the red line is the 50-day, the pink line is the 100-day, and the most sacrosanct line is the 200-day moving average. If the 200-day gets breached, I think there is a large expectation that there will be some amount of chaos and havoc in the market. The last time we had seen a substantial breach of the 200-day on the index was a few years back, a couple of years back, and therefore a big move even before that was the COVID crash, which I don't want to get into. But the current selling pressure is getting clearly reflected. Our take at O'Neill is that why do we clearly monitor the 21 and the 50-day moving average? Is based on the fact that I gave in my opening remarks that institutions are clearly monitoring a lot of these macro events, micro events that are playing out in terms of the thematic trends on how the global economy is shaping up, and on the domestic front, how these events might shape up the earnings for some sectors or most sectors that are getting involved as far as these macro changes are evolving and developing as we head into every passing week and month into the markets. And the financial markets will be the first to react with the positioning that will happen for the economy as a whole 6 to 9 months or a year down the line, and the reaction first in financial markets, as we always see. The ongoing selling pressure and why we monitor those lines and the moving averages is very clear. Because if there is any change happening in the ecosystem based on a combination of these factors put together, institutions will come on selling as well. And that selling will get reflected in terms of the moving averages getting reached. And therefore, if volumes are extremely heavy, if there is stalling happening in the market, if there is a distribution day which is getting accumulated, and these key moving averages 21 and 50 are breached, institutions will come and sell. Again, guys, we have put this very clearly in our webinars that we do at MarketSmith, in our level 1 and level 2 webinars as well, where institutions also monitor when they are selling or looking at factors for the market, the technicalities or the technical reasoning on why those stocks are or the sectors are getting sold. As an example, as I said, FMCG companies' commentary is okay, but again, not too sure in terms of the recovery. Banks, a large part is getting offset. Few banks giving decent, but a large part of the bank not giving decent. Large cap IT still disappointing. And therefore, those pockets of market, including the likes of L&T and Asian Paint, as I mentioned, gave weak set of number and weak guidance as well, which does not give confidence in terms of how the market movement will happen. Will the liquidity continue generally for the market? Just heading into that because I just dwelled upon that part. SIPs are still continuing very, very strongly. So you still got a SIP number of close to 21,000 odd crores, which is around $2.25 billion that are happening. If these SIPs continue, and as foreign institutional holding or a foreign FDI plus FPI holding close to 17.5, 18.5%, the worst that they had got to was in the COVID crisis when they had come to around 14.5, 15, if I remember the figure correctly. And therefore, I think FIs also do not have extremely heavy positions that are left into the market. They have been consistent sellers. And therefore, if the domestic flows continue, which they should and should remain, because this money is smart money which is coming in for a longer period of time, as retail investors have understood that sticking in the markets for a longer period of time will help you compound your wealth in a far greater fashion, which they used to unfortunately exit on every sale, and FIs used to control the market. So, to that extent, liquidity is extremely supportive for the market at this juncture. But for the bank Nifty as a whole, it has been a mixed bag, and therefore, if the breach continues, as I said in my opening remarks, you also have to see the sectoral composition, because ultimately the sectoral composition and the breakdowns will reflect on the index composition, as the weightages of these individual sectors and heavy weighted stocks of these leadership sectors determine a large part on how the main index moves. Then we'll come to the next sector. Commentaries had been reasonable. And to that extent, sorry, I missed auto. So let me come to auto. Autos have remained extremely strong and resilient, guys, during this entire bull market, and even in the correction that we are probably seeing. Even in today's market, the auto index was quite reasonably placed. So there is no pressure that is getting indicated. So if you look at the right side of the graph, look at the candle that the auto index made. Yes, the volumes were not significantly higher, but the volumes were decent. They were much higher than the previous few days. But it is not moving its and breaching its moving averages, which gives us confidence that Nifty Auto, through the numbers that they have exhibited, whether it's four-wheelers, whether it's two-wheelers, including stocks like TVS Motor, which give fantastic numbers, Tata Motors, which have given fantastic set of numbers as well. Bajaj Auto, there is Aisha's numbers which are expected tomorrow. Hero has given a decent set, and so have auto ancillary companies as well. So a large part of the auto universe has done well in terms of earnings. The entire structural story in terms of electric vehicles, electric mobility is something that is playing very, very positively for the index. So auto index very, very positively placed right now. And it seems that the index is positioned well in terms of the structural drivers, in terms of what can come through in terms of the entire transition from the internal combustion engine, which is the petrol diesel engines, to the electric part. And a lot of companies have done investments in an accelerated fashion to probably ensure that as the EV ecosystem comes into play in the next few quarters, they are ready and equipped to probably manage that pretty well. Which brings us to the next sector, which is the Nifty FMCG. As I just mentioned when I was speaking about the index level itself, again, I think it was a mixed bag largely. However, if you probably look at the placement of this sector, again, like the auto sector, very, very strongly placed. It did have some amount of hiccups, as the chart is indicating on the right-hand side. But I think there has been a strong recovery. Why has that recovery happened? Because I think if you look at the fag end of the results, a lot of FMCG companies gave a lot of positive remarks. They are seeing rural demand come back. And why is that important? Because for FMCG companies, around 60% of their volumes come in from the rural side. Urban has held up pretty well for these companies. But what you saw in the first 2 or 3 quarters is that rural sales were waning. For obvious reasons, there were deficient monsoons at the beginning of the last financial year. Discretionary spending had come down. But a large part of the market and what the belief is in terms of the Indian Meteorological Department and SkyMet that it should be a normalized monsoon this time around. And if the monsoons are normal, the farm output should be normal, which means that the MSP increases or the farm produce should get a reasonable amount of traction, giving boost to rural incomes, and therefore rural discretionary spending should come back with a bang. So certain stocks have improved their technical strength. We've written that in the left-hand column as well. Commentaries have been very, very supportive. How does that play out in terms of numbers is something to be seen. But auto and FMCG, as we speak today, are above their key moving averages and are looking relatively better placed, which which takes us to the next sector, which is Nifty IT. Again, large cap IT clearly disappointed. The expectations that are getting built is that if the US recovery is patchy, if the US recovery takes a longer periodicity of time, and if the rate cuts, which, as I said, were the market was expecting as per the dot plot to be 4 starting September, has now come to 2 or even 1 to a large extent, means that the earnings recovery will be back-ended for the US market. Now, a large part of our IT companies, whether it's large caps or mid caps, depend upon BFSI to be the main revenue contributor, followed by retail, followed by manufacturing. Now, if there is a certain element of slowdown happening in all these three elements put together, you can expect that orders which come through from all these three segments, whether it's from America or Europe for IT companies, which is also a very slow and steady process in terms of economic recovery, might get delayed by a quarter or two. And if that happens, the expectations in terms of earnings recovery on large cap IT specifically, which has been a little bit poor in terms of forward guidance, both in constant currency or dollar terms, might be soft. It might also indicate that if earnings remain soft and even if EBIT margins remain at a normalized level, the kind of traction that one determines on the bottom line, which we map through our EPS ratings and rankings, might remain a little bit subdued. And we want stories because we are growth investors where EPS ratings and earnings grow at a very strong compounded pace, getting reflected through their RS rating as well. In the chart that you're probably seeing, the IT index is fallen both in terms of has fallen short both in terms of earnings expectations. A large part of those companies do not have stable excuse me for that or stable compounded things, but also the technical parameters are weak because earnings are not coming through and there is clear amount of under ownership. Mid-cap IT has done relatively well. Certain stocks like KPIT as an example have done exceptionally, but they're trading in late stage basis. So in stage 6, 7, where I think the expectation is that these late stage bases, if earnings do not come at some point of time, might succumb. So our belief at O'Neill has always been that stage 1, 2, 3 are the best stages to invest in any stock. Anything beyond stage 4 and 5 is something that the stock might succumb if earnings are not made, if there is some kind of an accident happening for the sector as a whole, if there is a regulatory change and there might be a sudden collapse that might happen. And you're probably also looking at an expectation of a climax stop happening for certain companies. Some IT companies definitely disappointed, like Sonata, which gave a very weak outlook, Co4, LNT, LTI Mindtree. And therefore, I think the patchiness in terms of forward numbers is something that has problems. But clearly, IT has been an underperformer. How numbers will play out in Q1 will determine the course of this sector. Which gets us to the next sector, which is Nifty Realty. Now, Nifty Realty has been one huge mover. Even yesterday, you probably have read the news. DLF sold almost a large part of its inventory within a matter of 7 days. So the kind of appetite that is there in terms of pre-sales velocity and the kind of reflection that is happening, all stocks within this index are near their all-time high. Yeah. Obviously, the real estate cycle, and everybody's speaking about it, it's a 6-year cycle. You're probably in the third year, so on and so forth. So it also had its share of pickups in terms of earnings at the beginning of the year, but it slowly and steadily started picking up. And therefore, I think if you look at numbers that have got played out for most stocks within this sector, if you start from DLF in the north to Soba and Brigade in the south, Kolte and Godrej Properties in the west, or even the low income housing or the affordable housing companies, a large part of that group has performed exceedingly well because most of their numbers have improved significantly. A large part of their inventory has got sold off, and therefore, the kind of earnings expectations for this real estate sale will still continue. It did have a hiccup a few months back where it did breach, but there was a strong bounce back that took place. Again, today's move was very, very encouraging for the reality sector as a whole. So I think if you're looking at the sectors that we have discussed so far, auto, FMCG, and reality are three sectors which are standing out in the sort of carnage that we witnessed in the markets today. And therefore, monitoring these three sectors are going to be extremely important as we see it at O'Neill. Above key moving averages, all stocks near their all-time high. Earnings pedigree looks very, very strong. And therefore, even the ancillary space, like I talked about in the auto, have a look at that as well selectively, where EPS rating, RS ratings are good, where it is showing a good amount of institutional build-up, because we always believe a strong institutional holding and an increasing institutional holding, which is reflected by I in CanSlim, will reflect positively in terms of the expectations of the delivery of earnings and the price performance of the stock as well. And therefore, even ancillaries to a certain extent, whether they're plywood players selectively or ceramic players to a large extent, or tile manufacturers, is something that also can be kept. Because in a 6-year cycle, the first 3-year cycle belongs to the developers. As new houses get constructed, as new properties keep on coming into the market, obviously you'll need to refurbish that. You need to refurbish your new house or even your existing houses, which can give a fillip to the ancillary space as a whole as well. So reality is also looking good as we see that markets with India, along with autos and FMCGs, which brings us to the next sector, which is also surprisingly held up very strongly as well. Uh, uh, Pharma as well as the next sector that we'll discuss. So Pharma had a good move. I just spoke about the factors driving Pharma, and the underlying elements are that as new launches keep on happening, a lot of companies like Sun, Cipla within the large names, or even Dr. Reddy's are looking at niche products being launched. Dr. Reddy's is looking at some biosimilars, though I think results was a little bit disappointing. A few of these companies, including Sun, have FDA concerns on a plant in India, which was the Ranbaxy plant that had taken over. Cipla has some issues on the respiratory product, the approval thereof. But I think if you do a bit of forward-looking estimation, if these products come, and as I said, generics has become a huge problem in the US market of supply. A large part of these markets are of the belief that pharma can continue doing well. There obviously been some pullback, as you see on the right hand side, but now it is just below its 50 DMA as we speak. But today's candle has again been very, very positive, and therefore having a look selectively within this sector is very, very important. Some of the key underperformers in this sector, which were darlings in the earlier bull market, something like a Divi's and a Loras, has clearly affected the market to a large extent. But largely, I think these stocks, as I said in my earlier remark, even if the sector comes back as one of those outperforming sectors in the next bull run or in the next bull market or in the next time cycle, maybe different stocks take leadership position. So I think we'll always have to be cognizant of that fact that earlier bull market stocks, just because they are trading cheap, there are certain reasonings in terms of why they are trading cheap. There are a lot of fundamental factors, both DVs and Loras, in terms of their product mix, in terms of their capex that they had done a few years back. And because the fixed cost overruns are now higher with not incremental earnings growth happening in their existing portfolio, clearly reflecting in terms of deteriorating earnings and profitability. And if the EPS numbers are not to the mark, the markets are not going to reward you for the same. So I think being a little bit selective in pharma is something to be looked at. It was clearly an under-owned sector a few quarters back, but I think the ownership, as we see it, has improved in the preceding 3 or 4 quarters, which gets us to the next index, which is metals. And again, I think the large part of the metals move has been over the last 2 months. expectations of a China stimulus coming through, expectations of domestic demand holding very, very well. And even if numbers have been a little on the softer side, a large part of the market believes that inventory levels across ferrous or non-ferrous. So if you probably look at ferrous, which is steel stocks, Tata Steel, JSWs, the JSP of the world as well, you're probably looking at a large part of that market reacting in a certain way on expectations of what will happen. Now, again, LME prices, which is the London Metal Exchange prices, are largely determined in terms of the supply demand factors. And because China imports a lot of raw materials to process these metals, it is also called as a reprocessing economy, and supplies either semi-finished or finished goods, either in the form of billets or hot rolled coiled wires or cold rolled coil wires or finished products to the entire globe. I think that numbers have come down because China's real estate market itself is down and the excess supply has not come through because of underutilization of capacities there. And therefore, the LME prices across the metal space have come down significantly. Aluminum is having around $2,000. So is the case with zinc, lead, copper as well, though copper has shown some signs of improvement in the last few weeks. But both copper and aluminum, if EV ecosystem has to probably improve in terms of battery manufacturing, as an example, I think the usage of these metals are going to compound and increase at a very significant pace. And therefore, backward integrated companies, companies which have access to mines for aluminum mines, as an example, for core steel companies, is going to be coal mines, ore mines that probably are expected to give a significant impact. Because at some point, as China recovers, you will probably see input cost inflation start moving higher. And if certain companies which are exposed to these input costs might actually feel the heat, therefore integrated players might actually benefit. But again, this is one sector which has done exceedingly well. And again, what you're probably seeing at this juncture is that out of all the sectors that we've discussed from a market construct perspective, the overall market construct, the index composition, and the stock composition as well, autos, FMCG, metals are probably holding up. Pharma is becoming a support mechanism in terms of volatility for the market as well. And therefore, keeping a view and your eyes open in terms of these sectors as they perform, going through the sectoral rotation where domestic cyclicals as a combination through an exposure through these sectors will also get a huge momentum as our sector rotation graph is showing along with consumer staples. That is something to be watched out for. With this, I think I will end my part here. I will hand it over to Sony at this juncture. So just a minute. Yeah. So Sony, are you there?
Yes, hi, Mayuresh. So thank you very much, Mayuresh. I think that was a very detailed explanation of the sector rotation that is happening in the Indian markets right now. And I think all our clients and colleagues will be appreciative of the fact that you give them a heads up regarding what is happening in the market. So before we take questions, if we have time to take questions, I would just like to introduce an online platform from Geojit. It is called as Smart Folios. Smart Folios from by Geojit. This is an online platform wherein we offer stock baskets for our clients to invest in, and that is something all our clients can take. Can utilize. So whatever ideas that Mayuresh was just explaining, you can find those ideas in the baskets that are there in Smart Folios. Mayuresh and his team from William O'Neill, we have 3 to 4 baskets from their end in Smart Folios. So any client who wishes to take part in this investment journey, you may please log into smartfolios.geojit.com. Take a look at our services. We have around 18 to 19 different stock baskets, including baskets from William O'Neill. So this is ultimately placed as a broking product for all our clients. We manage baskets based on the risk profile or your preferred investment strategy. So I would request all of you to go through this smartfolios.geojit.com and have a look at the various baskets that are on offer. So just to give you a small rundown, we have baskets for our clients to invest in based on risk profile, preferred investment strategy. You register for the baskets. It's a broking product. We send the recommendations, and we send the recommendations via multiple avenues like WhatsApp, email. You can even log into smartfolios.goj.com. You can also download the mobile app, Android as well as iOS, and use these services of Smartfolio. So with that, I'll just hand it over back to Mayuresh and team in case if we have any queries or questions that our clients have. Mayuresh, we do have time for that, right? We do have time to take questions.
Yes. Yes, Sony, thanks for that. So yes, open for questions, absolutely. So you can just put it on the chat, or anybody can read it out to me. So Rushit, you can read it out to me. That's fine.
Sure.
So guys, you can just put it on the chat. Any questions that you've got, either related to the market or the smart folios as well. That me and Sony will be more than happy to answer.
So any queries, any questions, please type it out in the chat. And Rushabh has a question, but please type on the chat. That will be better. Like, coming to the women speaking, it's better to, post up in chat.
Rishabh, can you please type in your question?
So Sambit has a question on Piccadilly Agro.
Are we taking specific stock questions, Mayuresh?
So I can. So I think what has happened is that they produce the best performing whiskey, right? The Scotch Indri, if I'm not mistaken, and that gained a lot of prominence last year. Obviously, there has been a new winner this year around. But if you probably look at the construct on how this industry is placed, let me just give you the dynamics. One is the expectations in terms of the sales in terms of the liquor that we make here, right? And there are a lot of government regulations that come through. So how much of price increases that happen across states? And since elections are happening, a large part of those states have deferred price moves or price hikes, which also ultimately benefit these companies to a large extent. The second, obviously, is the input cost, both in terms of the core materials that they use and glass prices, because ultimately these products get sold to glass bottles as well. And therefore, how these two elements work out determine the entire margin structure for these companies as well. The last and the most important bit is the distribution network. So distribution network has to be extremely robust for these companies. And therefore, all these three factors should be at the right time. Again, institution holding, how the management bandwidth is, all these factors are important. And therefore, if you're looking at this space, look at the leaders. Is as simple as that. Because I think a lot of the low-run companies might be circumspect in terms of both these factors put together. Not arguing on Piccadilly's thing, but the management had some patchy issues in the past. So please look for leadership stocks within this space and all the factors that I mentioned.
So Mayuresh, there are 3-4 questions related to market. If I combine them all and present it to you, it's like, when will this fall in the Nifty or in the market stop? Where do you think is the support and it can reverse? And should someone buy now or wait for some other signals?
So I think मेरा तो hope है कि यार markets कल ही reverse हो, but it doesn't work on my hope. Again, if you go to the opening remarks, right, that I said, you now have to look at facts, and at Market Smith we looked at facts. So we have downgraded the market to an uptrend under pressure because there has been a breach. I give you a very detailed example and explanation on why that has happened. You will need to wait for at least the next few days or at least a week in terms of what the expectation is, right? Now, over the next 3 to 4 weeks, we'll have absolute amount of clarity because the elections will be over. The base part of the market on why it fell today was based on low voter turnout and whether the existing government will come with the required mandate or not, right? We'll have a good amount of clarity in absolute terms in the next few weeks if this was the reason for the market, because everything else in terms of structural drivers, leave aside a few companies which have disappointed, like I said, right? Reliance was not that disappointing, but yes, looking at the overall global construct, the numbers were still better. L&T clearly disappointed with guidance. Asian Paint has its own issues along with numbers that they posted. HDFC Bank has been a clear underperformer. So if you probably look at the top four, which have a large contribution to the index itself as far as the Nifty is concerned. And if the earnings are expected to remain patchy over the next quarters, you are going to see that reaction. Now, if you go down and break down every sector that I have done in today's webinar, you will see that some sectors are holding up, right? And therefore, if you look at the sectoral theory, the domestic inclined sectors, in our opinion, will still continue doing well because as and when and if the new government comes back to power, the existing processes in terms of government capex, in terms of spending on key sectors, on these structural themes will continue. And as that happens, private capex will come back very, very strongly. The support mechanism for the markets has also been liquidity. So, as I said, domestic SIPs are still continuing at $21,225 billion every month, offsetting a large part of the FI outflow that happens. Now, if FI suddenly sell, I don't know the figure, I'll have to look at the Bhav copy in the evening today. But if they sell suddenly 800 or 900 or 1,000 crores of stocks in a single day, you will see that knee-jerk reaction happening in the market. But are structural drivers absolutely gone very for the market? No. The structural drivers are still on the positive side. India still remains well placed. We are far better than most economies. A lot of our sectors structurally and domestically are expected to do well. And therefore, my hope is that you should not see a structural downside for the market unless 2, 3 things happen suddenly. Suddenly there is some element of geopolitical tensions in the globe happening over the next 2, 3 weeks, coinciding with our election results, which actually turn the market upside down. Or there is a slew of economic data which is so bad, which probably gives us to the belief that earnings recovery, which was expected in global markets by the second half, might get postponed in the next year as well. So unless that happens, I don't believe there is a structural downside. I hope
There's
I
one
answered.
question for Sony maybe, and that is related to smart folios. So Joe is asking that can you give a rundown how the smart folios are implemented, including the expenses and all?
Yeah.
Uh,
So
yeah.
regarding smartfolios, I'll just share the screen with you. So this is the smartfolios website, which I was referring to earlier. So how this works is very simple. With your GeoJit trading account password, you can log into smartfolios. You can register for a basket of your choice, in the sense we have from William O'Neill, we have 4 baskets that is named as Guru, LV Value, LV Growth, and Cancelim. So if you would like to take advantage of the outlook and the way forward, as Mayuresh was mentioning, you can subscribe or you can register for these baskets. As I mentioned earlier, this is a broking product. We will send you the recommendations, and it is up to you to accept it or not accept it, but we will send you the recommendation. So that is why we've specifically mentioned it as a broking product. There is no entry fees, there is no annual fees that we are charging. It is just the transaction fees that will be there, that will be charged from our end, from GeoJet's end, or from anybody. So there are no other charges when it comes for you to register for a folio. It is just that you register, we send you the recommendation, we will be reviewing it on a quarterly basis. We keep sending you. It is up to you to accept the recommendations or not. So that is very simple. That is how it works. You accept the recommendation, it gets executed, and there will be an execution cost to it. Just like brokerage, there will be an execution cost. So that is it. It is as simple as that. It is not very complicated. The only complicated thing for you is to choose which basket to invest in based on your preferred investment strategy.
Perfect, son.
So, as I said earlier, Mayuresh, I think you opened Pandora's box regarding stock. So you have, I think, Rushit must also be choosing which stock to ask you. But I mean, this thing, I think there is a couple of questions. What is your view on mathematical stop loss and technical stop loss? Which one would you prefer?
So we've kept the system very simple, folks, at O'Neill, right? So when I was speaking about the daily moving averages, what we've said is that if the market starts coming under some element of pressure that we've seen, you need to monitor the 21 and the 50 PMA very, very closely. Whether that breach has happened at the index level, if that breach has happened at individual sector levels, which I disseminated to you, and individual stocks within those sectors. Now you'll clearly get an idea on what part of the market where the sectoral rotation is happening, right? So clearly, I think it's some element of autos and pharma and certain bits of pharma where market is trying to seek protection, but other sectors are probably getting affected. So to that extent, I think have a look at these two moving averages very, very closely. Don't try to complicate things. At O'Neill, we always believe that keep things simple, easy to understand, easy to analyze. And this system has worked perfectly well across markets in the last 60 years. So I think just keep the system simple and work on that.
I think regarding PSU sectors as a whole, the PSU also you were mentioning the PSU sector about so
Yeah.
that is also what is your outlook on that?
So I think that was the hottest sector, right? Last year, everything performed. PSU ke sab stock bhag gaya the. So if you just say PSU and the stock would run. So look at how the Nifty CPSE index has also moved, right? And it was based on certain facts. So I did an interview with ET yesterday. I think that entire link is there in the Twitter bio, in my Twitter bio. I've given a very detailed presentation, but I'll quickly give you what the take is. Structural story remains strong. Defense companies, whether it's power companies, railway companies, construction companies, housing companies, where order flows are expected to continue at a fast pace. These orders are coming at good margins. PSU companies have understood the entire mechanism that they need to execute well. So they have seen the entire magic that the markets can give them. If they execute well, if there is a strong earnings probability, and they give a very strong outlook in terms of that execution continuing, the market re-rates. Along with government support, all the factors that are probably acting as tailwinds, and the innovations that they're doing. The entire universe, you look at PSU banks, right? They were averse to digitalization 15 years. And look at what has happened right now. Digitalization has taken over. They're ready for that. So yeah, I think selectively, yes, stocks within these spaces, space. So like an HAL has moved like a rocket rather than anything else. Some railway stocks have moved like rockets rather than railway lines or trains. So be a little bit choosy and selective, but the space can have structure.
Right. Okay. So I guess it's 5 o'clock, Mayuresh. I think perfect time to end this session. I think it has been extremely informative, and I think we'll need to conduct this on a regular basis, at least on a quarterly basis, where you can come and update the clients and our existing investors, which it will be very helpful if you can plan it out. So from our end, from Geojit's end, thank you. It has been a good association with William O'Neill. So hopefully, it'll grow from strength to strength with smart folios baskets that you are offering. So thank you very much from our end.
Thank you, Sony. Thank you, Sony, for that wonderful ending note. It was a wonderful experience sharing whatever I know, and it's always been a learning curve. I always believe there's so many things to learn in the market every day. I'm learning myself every day, reading every day. I've still got a book to read that I need to complete in the night. But yeah, what I could contribute, thanks for that, and do this on a quarterly basis, as you said. Very informative questions that are asked. But keep them simple, guys. And I know you are busy in your jobs, not it's like I do day in, day out. But you can take some time out to just dwell a little bit into a little bit of fundamentals, technicals of the market every weekend. I think that will make you a better and an informed investor, like we always plan to achieve ourselves as well. So thank you, Sony, for the platform.
Just the last question, I think Mr. Samvit has asked again, what is the name of the book that you're currently reading?
No, so I'm reading this macro note, which Jeffries and Nomura has put out. It's a nice 200-page note. So I have to finish these 200 pages by 12 o'clock and start reading it. Right.
All right. So thank you very much once again. Good talking to you. We'll meet again soon. Thank you.
Thank you.
Thank you everyone for joining us. Thank you for joining in this session. We will keep informing you. We'll keep updating you about further sessions with William O'Neill and Mayuresh Joshi. So thank you very much, guys, for joining in. Thank you.
Thanks, Sony. Thank you.